Welcome to Your Fincast with me, John and Sarah.
Hey, everyone.
Today is Tuesday, February 18th.
February 18th.
And we're diving into, kind of a crucial question for investors like you.
Yeah.
Where do we actually stand right now in this crazy economic landscape?
It is a little crazy.
We're approaching, those record highs again in the U.S. stock market, the S&P 500. It's climbing. Things seem, well, pretty darn good.
They do, don't they?
But are they really?
Well, John, there are always other factors at play, right?
Right.
And today we are going to untangle some of those.
Exactly. So we'll be looking at some expert analysis of the market trends and those all-important inflation indicators.
Right.
The PPI and CPI.
Yes.
Buckle up, because we're going to figure out if this market is truly as strong as it seems.
Okay.
What could cause a pullback?
Right.
Plus, we'll decode what those latest inflation numbers really mean for your portfolio. And of course, we have to talk about the Fed, our interest rate cuts on the horizon.
We have to.
Yeah.
So let's start with that market momentum we were just talking about.
Okay.
The S&P 500, it's been on this, incredible upward climb, right?
It has.
A lot of factors are fueling this growth. We're seeing strong corporate earnings, advancements in tech, even some positive economic policies.
So it's not all smoke and mirrors. There's some real strength behind this.
I think there is some real strength, yeah.
Okay.
But some analysts are waving red flags.
Oh.
Jonathan Krinsky from BTX,
Yeah.
he's pointing to what he calls weak momentum indicators.
Weak momentum indicators. What does that even mean?
Well, it means fewer stocks are participating in this rally.
Okay.
And the ones that are, well, they're not showing the same strength they were just a few weeks ago.
So is this like a canary in the coal mine? Should we be worried?
I don't think worried is the right word, but definitely informed.
Informed.
It suggests we might see a pullback.
Yeah.
Or a correction sometime soon. And remember, the market moves in cycles, right? What goes up
Must come down.
Exactly.
Got it. Okay, so let's move on to that word that everyone loves to hate, inflation.
Right. Inflation, it can feel like this big, scary monster. But we're going to break it down together using the data.
Okay.
We'll look at the Producer Price Index. That's the PPI.
PPI.
And the Consumer Price Index, or CPI.
Okay.
The PPI measures wholesale prices, what businesses are paying. The CPI, on the other hand, looks at consumer prices.
Right.
What you and I are paying for things.
Okay, so what's the latest? Give us the numbers.
Well, both the PPI and CPI, they saw increases in January.
Okay.
The CPI actually jumped by 0.5%, which is the biggest increase we've seen since July 2023.
Okay, so things are definitely getting more expensive.
Yeah.
What's driving that increase? Is it across the board?
Well, energy prices are a big part of it.
Okay.
Fuel oil is up 6.2%.
Yeah.
And get this, egg prices have jumped a whopping 15%.
15% for eggs. Guess I'm sticking to oatmeal for a while.
Might be a good idea. Well, the good news is it's not all doom and gloom.
Okay.
When we look at core PPI and CPI, which strip out those volatile food and energy prices,
Yeah.
we see a slightly calmer picture.
So the core numbers give us a better sense of the underlying inflation trends.
Yeah, that's right.
And what are those trends telling us?
They're still pointing upwards, but at a much slower pace. So it's a mixed bag, right?
Yeah.
Some prices are up, others are stabilizing. The key takeaway here is to stay informed and watch these trends closely.
Absolutely.
Now, the big question on everyone's mind is, how is the Federal Reserve reacting to all of this? They play a huge role in our economy.
Right. Their decisions about interest rates, well, those affect everything.
Exactly. And right now they're being cautious.
Okay.
Which makes sense given these mixed inflation signals we're seeing.
So they don't want to make any sudden moves that could rock the boat.
Yeah, exactly. Governor Michelle Bowman, for instance, she's said she wants to see a clear downward trend in inflation before they even consider cutting those interest rates again.
It's like they're trying to thread a needle.
Right.
Encourage economic growth, but not at the risk of out-of-control inflation.
Yeah, it's a delicate balance.
Yeah.
And with interest rates currently sitting between 4.25 and 4.5%, you know what that means for you.
What's that?
Borrowing costs could stay pretty high.
Yeah.
So that's something to keep in mind when you're planning your finances.
Okay, so we've got this market that looks good on the surface, but, some subtle warning signs underneath. We've got inflation that's kind of a mixed bag. And we've got the Fed playing it safe. So what's an investor to do? Where are the opportunities in this kind of environment?
Right. Let's talk about where to find value. The classic question, bonds or stocks.
Right.
Well, bonds have always been seen as kind of a safer haven in times of uncertainty. But with interest rates potentially on hold, those returns might not be as attractive.
So maybe not the time to go all in on bonds. What about the stock market?
Well, we've got this bubble market charging ahead, but we've also got those warning signs flashing, right? what's fascinating to me is how certain sectors are performing.
Okay.
One I'm keeping a close eye on is the energy sector.
Really?
Yeah.
With all the talk about renewable energy and moving away from fossil fuels, why energy?
Well, that's exactly why this transition, it's going to take time, right?
Yeah.
In the meantime, we're still heavily reliant on oil and gas.
Right.
And so I'm thinking there's still opportunity there
Okay.
in those traditional energy companies.
You're thinking there's still opportunity in those traditional energy companies?
Potentially, yeah.
Okay.
Especially if we see continued economic growth and demand from, emerging markets. Plus, a lot of these companies, they are adapting.
Okay.
They're investing in renewable energy technologies too.
So they're not just dinosaurs waiting for extinction?
Not at all.
Okay.
They're evolving.
Got it.
Another sector that's kind of intriguing right now is healthcare.
Healthcare, yeah. Always a hot topic, especially with, the aging population.
Exactly. The demand for healthcare services, it's only going to go up. And companies that are innovating,
Yeah.
developing new treatments, new technologies, well, they're likely to benefit.
So we're talking about biotech, pharmaceuticals, medical devices, the whole shebang.
Precisely. Lots of subsectors within healthcare that could offer, some real growth.
Okay, what about all the buzz around AI? It seems like every company is touting their AI capabilities these days.
Yeah, AI is certainly a game changer. And it's not just hype. It's already being used in so many ways, from self-driving cars to personalized medicine, even fraud detection.
Wow.
But as with any emerging sector, you have to be cautious, right?
Right. Separate the wheat from the chaff. So how does an investor navigate that?
Well, it comes down to research.
Okay.
Look beyond the buzzwords, understand the underlying business models, the growth potential of these companies. Don't just jump on the bandwagon because everyone else is.
Right.
And speaking of global trends, we can't ignore what's happening outside of the U.S.
That's right. What are some of the global risks that investors should be thinking about?
Well, geopolitical events, trade tensions, economic slowdowns in other parts of the world, these can all have a ripple effect on, our investments.
Yeah.
For example, the situation between the U.S. and China, that trade dispute, it's definitely something to watch.
So how do we hedge against those global risks?
Well, diversification is key, as always.
Right.
Exposure to different asset classes, different geographic regions, it all helps spread the risk.
Okay, so we've talked about market trends, inflation, interest rates, even some specific sectors like energy and healthcare. But I think it's time to answer the million-dollar question. What's the best hedge for investors right now, given everything we've discussed?
Yeah, it's the question everyone wants answered, isn't it?
It is.
And unfortunately, there's no one-size-fits-all solution.
I figured you might say that, but come on, give us something to work with.
All right. First, remember what a hedge is. It's essentially a way to protect your investments from potential losses, like an insurance policy for your portfolio.
Right, so we're talking about minimizing the downside.
Exactly. And the best hedge for you, well, it'll depend on your individual circumstances, risk tolerance, and goals.
Okay, fair enough. But can you give us some examples of hedges that investors might consider?
Sure. Diversification is a classic hedge.
Right.
We've talked about it quite a bit. Not putting all your eggs in one basket.
Right. Spread the risk around so if one investment takes a hit, the others can help soften the blow.
Precisely. Another popular hedge is gold.
Gold.
Historically, it's held its value during times of economic uncertainty and inflation.
Yeah, gold has always had that safe haven reputation.
Exactly. It can be a good way to preserve your purchasing power when things get shaky.
Okay, so diversification, gold. What about bonds? They seem like a pretty safe bet, too.
Bonds can be a good hedge, particularly against rising interest rates.
Okay.
When interest rates go up, bond prices tend to fall, so if you own bonds, they can actually help offset some of the losses you might see in your stock portfolio.
Interesting. So it's all about balance.
Exactly. Now, some people might be wondering about, alternative investments like real estate, private equity, or even cryptocurrencies.
Yeah.
Can those act as hedges?
Yeah, that's a good question. They seem riskier,
They do.
but could also offer big rewards.
They can. They can definitely play a role in a diversified portfolio.
Yeah.
But they also come with their own unique risks and complexities. So it's important to do your research. Really understand what you're getting into before allocating, significant capital to these types of assets.
So no jumping on bandwagons. Do your due diligence. That sounds like a good rule of thumb for any investment.
Absolutely. And remember, investing is a long game. Don't get too caught up in the day-to-day noise of the market. Focus on building a solid portfolio that can weather the inevitable storms and help you achieve those long-term financial goals.
Great advice. Thanks for taking us on this deep dive today. I think it's given our listeners a lot to think about.
My pleasure. Always happy to talk about investing.
Thanks for joining today's Fincast. Don't forget to like and subscribe. Take care.